Okay, very good morning. It's Monday the 5th of February, so hope everyone had a good weekend. Going to have a quick recap of the major headlines from over the weekend, and obviously much of the press dominated by the slide that we saw in global equity markets, initiated really by the US on Friday, where the Dow Jones closed down, Vas will like this, the number of the beast, 666. The Dow finished down as a point loss. And we'll look at some of the reasons behind that. We'll look at some of the other headlines from the weekend, and these are predominantly politically led, all the way from the US, which have their next talks about a further stopgap fix to avert a government shutdown. We've also got coalition talks in Germany, we've got Brexit, and Theresa May remaining under pressure as well. So that's what's on the agenda. I'm going to leave Sam to go over the charts in more detail. So really, other than just give you a quick overview of what we're seeing at the moment, I'm going to leave that side of things to him. But as you can see, the DAX future already down quite sharply. It's off its lowest level, center left chart here. You can see the DAX future. But we have followed generally the negative trend. So on Wall Street, let me just show you what happened on Friday. The S&P posted its biggest, in total, weekly loss in 2 years. In terms of Asia overnight, how has that performed? Well, they've played catch up to that lower close, and Asia's had its biggest drop in 2 years as well. So hence the kind of negative read across into this morning's open. It hasn't just continued selling off violently, because don't forget that we were here to catch a big portion of that move on Friday ourselves in terms of being situated in London. One of the other things, of course, that we had on Friday to initiate some of this renewed, if you like, expectation or fear about the return of inflation, which we've obviously been saying for a while is a key component to how well the markets will function in 2018. And we had non-farm payrolls, of course. And if you remember, we had the figure for wages come in considerably higher than expected. The US hourly earnings printed at 2.9% year on year versus just 2.6% expected. This came alongside a headline change in non-farm payrolls of 200,000, which is also above expectations, and you had upward revisions to the previous wage component as well. So this kind of Fed view that they've kind of continued to have this expectation that the tightening labour force will eventually start to equate to a pickup in wages and then consequently higher inflation, hence the reason why they've executed multiple rate hikes and continue to do so in the future, is starting to come to fruition now. So question is that, you know, how rapid is this inflation going to return? And this is the kind of big dilemma the markets are trying to handle at the moment. And just having a quick look through a sequence of different graphics that I've got here, this is obviously to put in context the loss of the S&P over the entirety of last week. And as you can see, you've got to go back all the way really to the beginning of 2016. This was another one here. So yields having now spiked to a 2014 high as the S&P has retreated close to 4% on the week. So you're starting to see some divergence between the two there. And then volatility, of course, something which was absolutely non-existent pretty much, or certainly at record low levels as measured by the VIX at the end of last year. That's now risen up towards getting close to 18. And as you can see, the last time we were kind of at around this point was really the US presidential election, so going all the way back to November of 2016. So markets certainly have livened up over the course of January and continue to remain interesting at the moment, and this week as well will be key as to whether or not that this sell-off has any longevity. A couple of other things though to speak of that a lot of the press are looking at this morning, and there's obviously quite a few people which are of the view that actually what we've had is just a necessary kind of function for this market, which had not seen any meaningful pullback in such an extended period of time, pretty much the most on record by most measures. And as such then, this is a kind of a healthy bit of a pullback, and the narrative hasn't changed, because if you look at kind of more micro level in terms of companies' earnings, economic growth, then there is some support and validation behind the higher equity prices. But what we're looking at here is the trend line, and Bloomberg basically suggesting that a 10% correction would not break the long-term trend line. So as you can see here, what we've been looking at. But obviously if you start looking at the bottom part, it's the RSI, and you can see here pretty much throughout the back end of December and certainly beginning of this year, it got very overpriced by that measurement. And so as such, you can see we haven't been that overpriced. Certainly going all the way back here, this predates that of the financial crisis. And so maybe it was a natural thing for the markets then to book some profit at that point, given the extreme run-up that we had of January, which of course is a month from an equity point of view, which the S&P gained over 7%. It was the biggest rally we've had for the month of Jan on record. So again, this is just a bit of a closer look at that RSI, so you can see it in a bit more closer fashion. So you can see here has been a relative good indicator of the kind of Q4 period of last year, because in September, October, November, when we've got just over that higher bound, prices then have started to book some profit on those initial moves. And if you look at January's performance, it really does dwarf that of the overvalued nature of the equity market from what we saw at the end of last year. One of the things here was, I think this is JP Morgan. They've been pretty resolute this morning, saying that actually this isn't the start of a major downturn. They continue to hold that view. And there's a couple of other things as well from their asset management division. So as you can see here, this is a chart to kind of graphically represent this 4-year high that we're trading in the US 10-year yield. You can see this really sharp elevation we had. If you remember a few weeks ago, it was really key when we were watching the break kind of just above this 2.5%, 2.6% regions when we broke that 2017 high, and it's really opened up now with obviously the upside target being, if and when we get to a test of 3%. But JP Morgan, their asset management chief global strategist, he's disagreed with the popular narrative that equities have been tanking because of fears of interest rates would rise due to higher inflation. He basically suggests a somewhat untidy but nevertheless more plausible explanation is that both the bond market and the stock market were overdue for a correction after a remarkably placid 2 years. So we'll see. Obviously we've got interest rate decisions coming out this very week, probably the two of most significance for the markets that we will be looking at. You've got the RBA, so Australian decision, which is coming tomorrow, and then you've got the Bank of England, their quarterly inflation report coming later on this week. Some other things though to be aware of from the weekend's press from a political standpoint. You've got the coalition talks are still ongoing at the moment, so party negotiators reconvened today after missing their target deadline again. Actually, this is the longest time that I think I'm right in that Germany has not had a government since the Second World War, in terms of the formation of this coalition, this grand coalition with Merkel's party, the CDU-CSU and the SPD. So this still needs to be monitored. I wouldn't say this is having a direct impact though in terms of market prices in the way that you're kind of trading short term the euro or the DAX or the Bund, but certainly it does need to be monitored in that respect. The one thing I guess just pointing out is that although we did have treasuries and bunds moving lower with equities on Friday, with this kind of heightened fear of kind of faster Fed rate hikes possibly, given that Janet Yellen is now gone as well, but the fact that this wage growth could start converting into inflationary pressures. But this morning you're seeing a little bit of a difference, because if you look at the Bund future, after gapping lower, we've been rallying ever since the open, and actually now we're up to 158.12, so we're back up about 25 ticks. So we've already rallied about roughly 50 ticks this morning in the Bund. T-note as well, seeing slight upside, about 3 ticks higher at the moment as well. So this equity pressure actually starting to translate into a little bit of more of that traditional move into fixed income. Gold as well has been edging up since Europe's come into the marketplace, with pivot upside a near-term level of significance. Okay, elsewhere on the political front, Theresa May. May under fire as Brexit reality sparks Conservative civil war. Sam smiling. The Sunday Times had what's being coined by the Brexiteers as the Dream Team. Michael Gove, Boris Johnson with Jacob Rees-Mogg as the Chancellor. The so-called, quote, Dream Team. Not sure if that really gives me the greatest confidence in the Brexit talks are going to go through smoothly. Obviously, this has come after May's been under a lot of pressure. May commits to leaving the EU's customs union. This kind of brings about that whole Northern Irish situation again, which is obviously key about the hard border and how they're going to implement the border with Southern Ireland. So, yeah, it continues to be a bit of a mess internally for the Conservative Party at the moment. Is this translating into any specific sterling weakness? Well, no, not really, because this isn't really that new. We've known Theresa May has been really under pressure for some period of time. She's been on a trip to China, and all she's been doing is getting a lot of her internal senior cabinet members seemingly all starting to turn against her at this point. So again, needs to be measured. In terms of a timeline, I still don't really see any near-term threat to her kind of vote of no confidence, because I don't think she would resign. I think a vote of no confidence is the only way that she'd be removed, and I don't actually see that being facilitated until after the March trade talks with the EU summit, which is the 22nd, 23rd of March. I think that will be really problematic for Theresa May, because she'll come out of that not particularly in a strong position. Then you've got the local elections happening in the UK in May, and then that's when I think she's going to go. So just to give you a bit of a timeline. I don't think we're quite there yet. Talking of UK, we do have this week, and this is the Bank of England, and we get their quarterly inflation reports, and Mark Carney faces up to a newly hawkish market as bets on May hike grow. Now, if you remember at the time when the Bank of England delivered kind of a dovish hike, if you like, they removed the emergency cut that occurred after the EU referendum, so rates now at 0.5%, of course. But one of the things here is that they telegraphed that the Bank of England is only going to hike rates twice up to the end of 2020, and I think that was incredibly dovish pricing or communication for the Bank of England. And the market is very much reflecting that at the moment. And so what's going to be key is, no way the Bank of England are going to move interest rates this week, but what we're going to be looking out for is any meaningful shift in their communication towards what also has been some improving wage data that we've had in the UK. But you've also got the other side of the coin, which is Brexit. We don't really know how that's going to play out yet. So there remains plenty of reasons not to really take action thus far. But when does the market anticipate that the Bank of England will act? Well, if you look at this chart here, this is market pricing. And traders are now pricing in around a 60% chance of a Bank of England increase in May. And so, as you can see by this chart, here the percentage chance of rate increase to 0.75%, so 25 basis point increase, is now at 60% probability. So as far as the markets are concerned, the Bank of England are going to hike interest rates this year. What does that look like in terms of a survey of economists? Well, of those surveyed just last week, you can see here the majority think rates will lift in May. There's some looking at, and if you remember, the pattern of the quarterly inflation report, of course, is May, August, November. So these types of months here is when the Bank of England is more likely to act. So it's either they pull the trigger in May, or most people think it's not going to happen until much later, i.e. beyond this year. Finally, Italy. Italy is not really too much of a focal point right now, but it soon will become so, because 4th of March, you've got the Italian elections. Not too many people really talking about this at this point in time. There's so many other things to look at, particularly this rout in the global equity market at the moment. But Italy, the interesting thing that's been developing here is that the centre-right only 2 percentage points away from majority. And so pollsters say right-wing votes are often underestimated. So do you remember when we had the EU referendum or the US election, there was this so-called shy factor in the polling process, i.e. people like certain individuals who are very shy to say who they actually vote for, secretly go into the polling booth and you go, do you know what, I want Trump. Even though I'd never tell anyone that, I definitely would support Trump. But if I was to actually vocalize that in public society, I'd be demonized as some sort of right-wing, someone who needs help.
Because there's no equality of views.
Yeah, because there isn't any equality of views. Absolutely right. Well, I agree. So this is one of the things, though, that still is very difficult to manage at the moment. And this is because Berlusconi's revival. So polls may be downplaying the chances that a centre-right coalition backed by former Premier Silvio will win a majority in the upcoming Italian elections. This is really key because it's been a very tightly contested race where the likelihood is there's not going to be a majority. But what we're seeing at the moment is that actually, if the polls are underestimating this centre-right, then actually they could come back. And if you look at what's happening here, which is a monthly weighted averages of selected polls, you can see the centre-right has been creeping higher and higher. The centre-left has been probably the biggest casualty. The five-star movement has been relatively consistent. So this will need to be monitored in the weeks ahead. Okay, quick look at the calendar. I'll hand you over to Sam. Today, what we're really looking at is some PMI data, but these are the final readings in terms of Europe. What I'm more concerned about really is the services PMI coming out of the UK. So any sterling traders, I'd pretty much sit on your hands and wait for that data to hit in about 40 minutes time. That would be definitely worth checking out. And then going into the afternoon, you're looking at ISM non-manufacturing coming out of the States. You've also got ECB's Draghi, but is speaking on the ECB's annual report for 2016. So not really expecting a great deal on policy, but whenever the president speaks, it's definitely worth paying attention. Looking at the week in its entirety, just to give you some context to where the kind of peak of interest will likely be. So you've got the PMI data, as I said here, Tuesday, so you get the RBA interest rate decision. So that looks like it's going to occur overnight, so when we come in tomorrow morning, so any Aussie traders. You've got US trade balance coming on Tuesday, the regular oil inventories. Wednesday, pretty quiet. Thursday is when Bank of England, you've got the quarterly inflation report, obviously the minutes and so forth, and the press conference of Carney and his team. And then Friday, UK IP, manufacturing production, trade data as well. So quite a UK-centric week. Services in the morning. You've got the Bank of England decision on Thursday in the QIR, and you've got some other data, manufacturing, trade-led on Friday. US, fairly quiet on the data front, but what I would be mindful of is Fed speakers this week, because in the context of the very strong data that we had out of the US, it's going to be really key to see the Fed's communication. How do they try to handle this renewed pickup in wages and these heightened inflationary concerns reflective in the high yields that we're seeing? How do they look to either agree and look to move 3 to 4 hikes, or disagree and try to manage the situation to not get the markets too overpriced? The other final thing for this week is the risk of a shutdown of the US government towards the end of the week. The deadline is Thursday, the 8th of February. To give you an idea, Bloomberg News has reported over the weekend that Republicans are looking at extending the government funding until the 23rd of March. And that's broadly consistent with most major banks' views about a 3 to 4 week continuing resolution. So again, not one big kind of grand deal to be done, but just another short-term fix and stopgap to keep the government funded to the end of March. Okay guys, that's it from me. Going to hand you over to Sam. Have a good day.
Yeah, good morning guys. Hope everyone had a good weekend. It seems as though things are sort of turning around. Obviously Arsenal even winning comfortably, but I think we'll start with the equity markets, which is still near those levels not seen for well, since the beginning of January really. But in terms of where we could perhaps find support straight away on S&P, we found this, and I saw CH in the chat. You took a long off this level, which technically is really, really strong support. Whether this is the one that holds or not is going to be it's going to be tricky. It's going to be interesting to see for sure. The sell-off really sort of caught fire, as you can see, on Friday. And I was in the office still at the time, around sort of 6:37, and there's none of these levels of support were holding at all, breaking through all sort of simultaneously in the Nasdaq and the Dow as well. Lower time frames just to see places where we could perhaps look to continue. You can see it. What was a bit of support on Friday evening, just before the close, has acted as good resistance now. So, in terms of a sort of ceiling to the move so far today, this is the point for the S&P. I'd definitely be aware of 27.55. And sort of a bit mid-range for now, but we'll see if maybe get a bit of a trend line on here, and if we were to break through, it could be quickly down to the lows again to have a bit of a test there. The Dow, usually obviously not the best markets to be talking about for the morning, but considering what did happen on Friday, and it is on sort of the front page news, the headlines that have been talked about for now. Definitely worth keeping an eye on. If we were perhaps maybe to break through the low just marked up here, it could be that we do get a bit of a test down to the S1 level. In terms of where a strong area of support for the Dow could be before we have a look over for the Nasdaq as well, you can see we actually broke through what was the similar level in the S&P, but it has offered a bit of support, although it would have taken obviously a few people out there on a bit of a stop run. The Nasdaq, all markets obviously in the States looking very similar. This is a point where it seems to have almost tested for the Nasdaq, a big level, and I think if we do break these low points that we saw in the very early hours this morning / 11 p.m. last night on the open, then it could really open the door again. In terms of the upside, I think it's been a tricky one to sort of call the upside, so it'd be definitely my advice would be to sort of identify the key resistance area and only look to buy if it does break through there. So I mean, for the Nasdaq, it could be if we were to break above this point, saw Friday evening, then the bias sort of come perhaps into control. But I think the bias has to be for now to the downside to continue the trend. The DAX done its usual up down, so looking pretty messy. Got a bit of a ceiling around here near the high of the day, and obviously the low, an important point to be aware of. We made levels not seen in the DAX for quite some time. I was going to put this on a longer chart and just remove the pivots just to clear it up a bit for you guys, and you can see finding a bit of support on levels that we found in the back end of September, so definitely worth keeping an eye on. We found a bit of resistance, as you can see here, which would have been a nice trade not too long ago to have taken there on what was the previous low of 2018, and just sort of capping the upside for the recent move. Having a quick look over currency markets, FX. Let me just get the pivots on here. So for now, the high of the day in that pivot holding as quite good resistance with the 125 handle for euro. Low of the day looks a good support, sort of stuck within that range now, and it'll be interesting this week to see whether last week you saw quite a choppy market for all currencies. You can see here very, very choppy. One minute it seems like the dollar strength is returning, and 1 minute it's not. So in terms of a longer term trend for these markets, I would be a bit cautious about perhaps taking anything on too risky. UK data coming out at 9:30 perhaps makes you want to stay away from getting into the market, but we're just pushing to a new high as at the moment, just broken through that 141.52. So it's always a bit risky still with 32 minutes to go to the data. I wouldn't necessarily want to be jumping in, but technically pushing through, and then you can see some nice resistance up towards the pivot and resistance areas from Friday evening. So the currency markets, it's caught my eye at the moment, looking at dollar yen, which is just on that low of the day. Some interesting support points from Friday morning to be aware of if we can continue to push through here. Just to finish up, have a quick look over at the Aussie dollar and the CAD, and you can see similar sort of story as with that euro, with this currency pair just on the high, but just finding a bit of resistance for now. And if we look at dollar CAD, obviously it'll be the same as the dollar yen, with the low of the day finding a bit of support. Friday afternoon's high as well has not been officially tested in this dollar CAD, so I would expect a decent reaction there. In terms of the direction for the week, I have to say it's going to be quite tricky, and maybe perhaps best for anyone looking for a more medium-term trade just to wait for almost the dust to settle and there to be a really clear breakout either way. Gold, you can see, if I just make this chart a bit bigger, there you go, find really nice support from the 18th, 17th of January, and we're just sort of bouncing quite nicely from there. So another level to be aware of. If anyone was looking to perhaps continue the downtrend, you've got to mark up this area around the pivot where we saw a pullback on Friday evening, and would expect a good sort of challenge to the upside, or any potential upside to come around there. Just pushing to the high. Dollar index just slightly weaker, down 0.1% there as well. Worth for those crypto traders, just have a quick look over at Bitcoin at what it is doing. You can see, well, currently right on the, well, it's just literally made a new low for the year, 7,700 on the futures chart. So seems like the sell-off is continuing. You know, struggling to find a green candle in the last couple of weeks there.
End of week call.
End of week call.
What do you reckon? Bitcoin?
End of week call. 5,000. Let's go. Let's go. Let's see. I mean, that might even be not optimistic enough, but let's wait and see. Just to finish up, we'll have a quick look over the FTSE, which caught my eye earlier. Let me just get this going here, and you can see the continued sell-off last week. We just had a bit of a bounce. I would say the level that really does interest me is if we can get down to the lows of December. Let me just circle that up just to make that a bit clearer. You see here the sort of the lower the 30th, and then the January, lower 30th of November, and then beginning of December low. Looks quite good. I know this is CFD chart, but the levels will align across all different platforms. But as mentioned, data out in just under 30 minutes for cable, so I wouldn't want to be jumping into a trade necessarily, but you are just seeing a little push through there. Euro around that high has found some nice resistance, come back down to the pivots. Anyone that did perhaps get in on the high of the day, not at the worst place in the world to perhaps look to take some profit off there just to reduce the risk. As usual, any questions, please do get them in the chat, and we'll obviously be posting charts throughout the day. But hope everyone had a good weekend, and we'll catch you soon.